Okay, here we go.
Good morning. How's everybody doing? I hope you can see me. I hope you can hear me. We are live, Pure Exposure Growth series, still in our quarantine, shelter in place, stay at home, don't go out, whatever you want to call it. So we are not in our studio. I am in my home office.
Here we go.
I thought we just went.
Yes, we did. All right.
Tony, if you could mute yourself because I'm hearing your feedback into here. So that will help a lot. Hey guys, my video should be on in a second. I don't know if it is on, but I'm going to keep talking. My name is Bob Iacchino. I am the host and the co-founder of Pure Exposure Growth Series. And with me today, I have a really good group of guests. I have Kamal Sri Kumar, I have Scott Bauer, I have Serge Berger, Jim Iorio, Mike Arnold, and then we've got a special after show for you guys that might be interested in some of the alternative assets. So we'll talk about that as well. But first, I'd like to start, if I could, with my good friend Kamal Sri Kumar. Sri, can you hear me?
I can hear you very well, Bob.
That's wonderful. I want to tell you guys, he is the president and founder of Sri Kumar Global. And before we start talking about markets, I have to say, you guys have heard me rave about Sri before. I've raved about you on Twitter. I've talked to you in person, so you know my opinion of your views. I think he's the best global macro economist out there. So before we begin with questions for him, I want to point out that he's not a registered investment advisor. So his views are coming from the perspective of a global macro economist, not an advisor. So these are not this is not trading advice, it's not trading ideas, just Sri's very top-down view of the market, which I think in this particular time, Sri, is extremely, extremely valuable with some of the things that are going on with the Fed. So I wanted to ask you about interest rates before the actual market opens. I think it's important to talk about sort of the background structure of the markets. And something that we saw in April was that 10-year yields basically went from an opening of about 62 basis points, so less than 0.75%, to a high point of about 0.75% on that yield, and then back down to where we are right now, which is 62 basis points. And in that time, we had the best market for equity indices basically in about 20 years. So how do you sort of square that circle? Where do you put interest rates versus equities right now? Because shouldn't they go back to their normal relationship?
Bob, those are great questions. I think what happened in April was equities surging up on the basis of expectation that a cure to coronavirus, or at least a vaccine, would be discovered soon. That was one factor in the equities rally. And the second was that the economy would recover much faster than expected as a result of opening up of the economy that President Trump has spoken about. The bond market simply did not buy those stories. And that is what you got from the 10-year yield going up to only about 75 to 78 basis points.
Right.
And as you said correctly, it backed off and it went to between 60 and 62 basis points in the last few days.
Right.
So what I would say is that this is a repeat of the pattern that we have seen in the last two recessions, the short recession of 2001 and the long Great Recession of 2007, 2009, when the 10-year inverted, then started steepening in anticipation of a Fed easing, all ahead of the start of the recession. The equities side, on the other hand, S&P 500, reached a record high in October of 2007, 2 months before the Great Recession began. So if you depended on equities to tell you that the economy was going to sink, you simply did not get the message.
Well, in that vein, Sri, let me ask you, because didn't we see a dramatic steepening of the curve in the first quarter from it being inverted toward the end of 2019 to a little bit of a steepening? I mean, it's not a steepening that shows a dramatically expanding economy, but we went from an inversion, which by the way, you predicted probably about 2.5 years early, if I remember right. You predicted that inversion, we got the inversion, then we got a dramatic steepening. Is that the same type of interest rate action?
That is the same thing that is happening. And this is a repeat of the last two developments, 2001 and the 2008, 2009. Here is the story. We had Larry Kudlow once get on TV and mention that the fact that the yield curve was steepening through a good part of 2000, toward the end of 2019,
Right.
gave him confidence that the economy would remain strong in 2020. And I immediately tweeted out saying that is erroneous, because that is typically what happens before a recession.
Right.
It inverts and then it starts to steepen, not during a recovery. It steepens before the recession begins, because the market is starting to expect that the Fed will ease faster than the 10-year will fall. That's the message. And you should not be reassured by the steepening of the yield curve that is taking place following an inversion.
So how do you think this was a predictive inversion then? I mean, obviously we're in a recession now. You can't, the National Bureau of Economic Researchers they won't name the recession until later, but clearly we're in one. We're in a global recession. Would you agree with that?
We are in a global recession. The IMF is probably still underestimating the depth of the recession by talking about a 3% drop in global GDP. In the United States, we are talking about 10% plus, 12, 15, take your number. So yes, it is a global recession. And one more fact here, there are only two major economies in my mind which are going to show positive growth, tiny, minuscule positive growth for the calendar year 2020. And those are going to be China and India. That's it. Everybody else is going to be negative. And that is a global recession for you.
Is that simply because China and India are coming from such a high place of growth in the first place? Or are they actually growing?
They are growing for two reasons. They are growing because of a large domestic economy, as you said. And second, they have a big consumption base domestically. So China is now being hit, for instance, by the fall off in global trade, because global trade is a big victim of coronavirus. It's just plunged. And countries like China, Japan, South Korea are big countries for exports, and that is suffering. So China also has a domestic consumption base, which is going to increasingly rely on. It's going to have more credit growth. On the Indian side, it is coming from the amount of people demanding goods and services at home. 60% of GDP in India comes from domestic consumption. Compare that with Germany, for instance, where 46% of the country's GDP is from exports. So it's going to be badly hit. So that's how you make a measure.
So are you saying those two economies will have growth in 2020 or going forward in 2021?
In 2020 itself, that they would have a growth, but it's nothing to feel envious about. We are talking about plus 0.5% growth, if anything.
Sure, with that giant consumption base, that should be much more, it should normalize at a much higher level.
Exactly.
Right? So that's still a painful level of growth for those two economies, correct?
Absolutely, because there is a lot of poverty in both countries, and plus 0.5% or plus 1% does very little to relieve it.
So let me ask you, you mentioned China. There was a rumor going around that there was going to be a problem with US debt, RE China. So can you talk about that a little bit and talk about what your opinion of that is? Because we saw yields spike a little bit on that.
Thursday was the day you're referring to, Bob, and we had the 10-year yield go from about 60 to 63 basis points in a hurry in about half an hour's time. And that happened when there were lots of rumors from Washington. There were trial balloons being floated by members of the administration, in my view, saying that China, and particularly Wuhan in central China, was where the virus originated in a laboratory. So in other words, it did not happen from a meat factory, it didn't happen from a slaughterhouse, but it did happen from a lab. And that China had not disclosed it, they needed it to be punished, and so on. Let's forget those rumors and see what it did to the markets. I tweeted out saying, you cannot think of a more harebrained idea to come out of Washington, D.C. than to talk in terms of repudiating US Treasury obligations to China. Recall, presidential candidate Donald Trump once mused about possibly restructuring US sovereign debt. These are things you simply cannot touch. This is something you don't want to deal with, for the risk being that the treasury yield shoots up, and then at some point in time, US loses its status as a key reserve country. Fortunately, we had that rumor very quickly shot down from Washington, and the yields subsided again. But what's going to happen, Bob, is in the next few months, there are going to be repeated efforts to quote unquote punish China, whatever that means. However, the president is hamstrung in terms of what he can do.
Right.
If he reimposes tariffs because the Chinese are not buying much of US farm products, the impact will be terrible for US equity markets, and my bond forecast will come true faster than I thought.
Let's talk about this bond forecast, Sri, if we could. You have a pretty strong forecast about where 10-year yields are going to go. And then if you could talk about that in relation to what the Fed's reaction would that to be, because clearly we're talking about a world of stimulus now, and that's all there is to it.
We have had a lot of stimulus, and starting with that point, my estimate of stimulus is, my number is about $11 trillion worth, adding different sources. And that compares with the US GDP of 22 trillion. So you're talking about 50% of GDP. This is unprecedented in terms of the amount of stimulus we have.
Right.
So what that has done, that is going to include purchase of bonds by the Fed, and that is a major factor in the US Treasury yield coming down. But my belief, something that I've held over the last 4 years, when I started talking about US bond yields coming down rather than going up, starting in 2016, is the fact that there are only two fundamental reasons why bond yields go down. One, because economic growth expectations are not very positive. And two, inflationary expectations remain muted. And let's come to the present. You're not going to have any rapid economic growth anywhere in the future. If anything, it's going to be whether it is minus 10% or minus 15% that you're talking about. And you are going through a disinflationary phase as far as the prices are concerned. Put them both together, you get lower bond yield. And that is where I say that it is not the Fed action that determines bond yield in the short term. It is what happens to growth and inflation.
So we have about 2 minutes left, Sri, and I want to pose two quick questions for you. Number one, do you see inflation anywhere in our future? I mean, let's talk about, obviously, you just mentioned we're in a disinflationary environment now. Do you see inflation anywhere in our future? And part two, someone recently said to me that equity markets are now liquidity, not earnings. That it's not a function of how well the companies are doing. It's just a function of if we have central bank liquidity. And I could argue that in the past, it's always been liquidity. If a company can't borrow, if they can't function, if they can't get credit lines to pay their employees, et cetera, that it's always liquidity. But this is central bank liquidity. So A, do you see inflation anytime in the future? And B, do you believe that we will only trade from an equity perspective on liquidity in the stock market?
Given the short time, I'll keep the responses short as well, Bob. First, in terms of inflation shooting up, I'm going to become a bond bear, believe it or not, for the first time in 4 years, perhaps starting in 2021, when I think the Fed and the US Treasury, irrespective of who the new president is unable or unwilling to pull back the stimulus. So with such massive stimulus and a lot of it going to low-income earners who will spend the money, you're going to have inflation pick up, you're going to have bond yields rise, and you have dollar under pressure. Second, your question concerning what is happening to the equity market, it is only in the short term that you have the easing by the Fed having a big impact on the equity market.
Right.
You cannot fight the Fed in the short term. You cannot fight fundamentals in the long term.
That's a great.
And if you don't have corporate earnings growth, and if you don't have the economic recovery, the equities are headed down, not up over the long term. Now, of course, I'm not speaking like a trader. I'm speaking like an economist looking at the medium term. So those would be my responses to you.
I also want to point out, Sri was not saying that the virus was invented in a lab. That was the rumor that was related to the subject matter we were talking about. Sri, thank you so much again for being here. I wish we had more time, but I want to go to Scott Bauer soon. So again, thank you for taking your time. If you
You're
don't
welcome.
know where to reach Sri on Twitter, Sri, can you give people kind of an idea where they can follow you?
Yeah, the Twitter is at Streak Global. So that is at SRIKGLOBAL. Thank you very much, Bob. It's a pleasure to be on your show.
Sri, it's been fantastic. I always love talking to you, and I will always push your Twitter out there to everybody that is involved in markets. Guys, we're going to be back in 1 second with Scott Bauer. Scott's got some pretty interesting things to say about a couple of stocks and about the VIX. So we will talk to you in about 14 seconds. We are pretty much back, guys. Again, this is going to be a little clunkier than our normal show because we're not in the studio. We are in our homes. As you can see, here's my goofy whiteboard that because I'm an old guy, I write the dates on there and write things that I have scheduled all over it. Behind me here, by the way, is a picture of, can you see this? Yeah, the Chicago Board of Trade on VJ Day with all the streamers and stuff going down there. So pretty much a Chicago guy here. And I'm bringing in another Chicago guy, Scott Bauer, who is the president of Prosper Trading. Prosper Trading is an educational group. They teach people how to trade stock options and along with some other stuff. Scott's just a really good guy and he's got a diverse background in the markets. So Scotty, I want to welcome you back. You've been pretty much a semi-regular guest on our show. And
Thank you, sir.
Let me ask you, I don't know if you could hear Sri because again, we're in a different setup than we normally are. Do you have any reaction to anything he said specifically about the interest rates? I mean, he thinks the 10 years going to zero.
Yeah, I mean, we're not far off from that right now. I don't disagree with him right now, but you know, so much of this, Bob, is and so much of everything that happens here in the market is so dependent on what happens with the virus and treatment and testing coming up in the next few months, right? So you know, in terms of predictability of where rates are going, where gold is going, where the overall market is going, fundamentals are almost out the window at this point, and so much just depends on how quickly can the economy get back to some sense of normalcy, which all depends on how quickly we can get testing and all the others. So, you know, I'm not one to make predictions at all. I don't disagree what Sri said at all. I think it makes a lot of sense. However, so much of that is out of, you know, anyone's control, quite frankly.
It's a great point. I was talking to a trader about some of the data that was going on, and it was when the next jobless claims number was coming out last week, which I believe was about 3.84 million or 3.48 million, somewhere around there. And the number actually came out, and he goes, "Wow, look at that, 3.8." And I go, well, "What does that mean to you?" He goes, "I have no idea."
Exactly.
Yeah, he was just saying wow to the number. He had no idea. So I have a theory that we've now gotten to the point where they're able to handle the jobless claims. So that's why they're going down still to extremely high levels. But there was a bunch of people that went and applied right away, and it went 6 million, it went 6 million. Let's start off at 3, then it went 6, then 6, then 5, then 4, then 3. So I do think it's getting better, but not because people are being hired back yet. Obviously, we just started openings, but we've got 22 states opening in the next 10 days or are open in some way, shape, or form already and over the next 10 days, representing about 28% of GDP if they were to be fully running. I also have a theory, Scott, that we're going to be looking at some weird data going forward, like Georgia restaurant reservations would be one of the things I'd like to find a source of data of. How much do you think the consumer economy is now going to start to reprice the stock market? Because obviously, as Sri and I talked about, we're trading liquidity in the early stages of this move up. And I guess the longer question is, do you think the bear market is over? And I won't hold you to this, but long term, do we go back down? Do we go back under bear market? Would you call that a second bear market? The floor is yours.
All right. So number one, in this environment, in this particular instance, I don't think that even being the Monday morning quarterback or looking to the future, I don't think we can say we entered a bear market or we're out of the bear market. We have never seen, the market has never seen moves like this that were dependent upon something outside of technicals, fundamentals, something that was outside of what we've seen in the past. This was all due to this extraneous situation. And how do you measure that, right? So, sometimes you have to take history and take it with a grain of salt. Great benchmarks to go with, the 10%, 20% down, what measures when you go into and out of a bear or bull market. But this is a completely different situation. So, do I think we're going lower before we go higher? Yes, I do. Do I think we're going to hit the lows that we saw towards the end of March? I don't think we will. To me, the most important thing moving forward here, like you mentioned, right now we've got, 22 states that are, at some level are prepared or have reopened.
Right.
So to me, the market direction from here really can't be told for at least another 4 to 6 weeks.
Right.
If 4 to 6 weeks from now, we get data that suggests that the reopening did not worsen the situation in terms of the number of people infected and or, at a worst case scenario, the number of people that have died from the virus, that is an absolute positive, right? If we can reopen gradually and not get worse numbers from the COVID standpoint, phenomenal for the market, phenomenal, obviously, for economics, and most importantly, phenomenal for all of us. However, if we get some data in the next 4 to 6 weeks that suggests that maybe this wasn't the right opportunity, maybe this didn't go so well, that to me would signal then that we could have, really sell off hard. Again, I don't think we're going to get to those lows, but I think the jury is still out there, Bob, and so much depends on getting going again and how successful it is, not in terms of people getting back to work, but in terms of the ultimate, which is number of deaths, unfortunately.
If I'm hearing you correctly, I think you're saying something to the effect of words matter, but they almost don't from our perspective. In other words, if we're in a recession or we're just above a recession or we're in a depression or we're in a bear market because we're down 20.2%,
Right.
as opposed to being down 19%, words matter, but they have definitions, and those definitions don't matter on a day-to-day basis. The example I use is you can look up the sky and say, like you would say to your family, it's cloudy today. But you wouldn't say, by the way, those are stratus clouds, not nimbus clouds.
I agree. That's a great analogy. It's a great analogy. So, you go with historical benchmarks, you go with historical data, but because this specific situation is different than anything that any of us have ever experienced, even the smartest economists, the smartest analysts, the smartest market gurus in the world, this is a different situation. Absolutely a different situation. And I think it has to be taken as such, meaning that there is no defined benchmark out there for what we are going through.
So something we do on PureXposure is we talk specifically about trades and things that we're looking at. Scott, you're looking at some actual, I want to say it's earnings coming up, but you're looking at MasterCard, Visa in relation to PayPal and what's going on with those. So can you talk about that a little bit?
Yeah, if you look at some charts, and MasterCard and Visa both had earnings already, PayPal's coming up. If you look at both MasterCard and Visa, those things had massive rallies off of the bottom, like many stocks did. However, they topped out, they stopped and met unbelievable resistance, both of those stocks, right at their respective 50 and 200-day moving averages after they reported earnings, and have actually declined considerably since. PayPal, to me, is in a different situation. PayPal, if you look at a chart on PayPal, has actually blown up through all points of resistance, other than some resistance where we're trading right now around the 120-ish area or so. But in terms of looking at the technical data, the 50 and the 200, I think this one has the chance, unlike Visa and MasterCard, to blow through. So, those are the three big payment companies in the world. Maybe Square is another one, but PayPal certainly to me. And you can see it. We're right at that point there, right? You look at those moving averages. We're right at that point there. I think this one takes a different direction than Visa and MasterCard did.
And also, I could potentially put this to Mike Arnold in the next segment, but we've got a triple top in PayPal on the weekly chart. And triple tops, people don't know, tend to be continuation patterns. So if we've got a third top right in the same area, which you mentioned, it's about 120, 150 or so,
Yeah.
122. That's generally because a double top, which is a reversal pattern, failed. And so you've got another top going up. Triple tops usually break out in the direction of the trend.
Exactly.
That is up.
Exactly. So I'm pretty bullish in PayPal.
Okay, so you got a specific way you want to look at that particular trade, or is that something you can't really go into?
No, I can absolutely talk about that. I'm a volatility trader, and obviously with earnings coming up here, volatility is extremely, extremely expensive. So what I am looking to do is play this with some upside directional delta plays for those that understand options, but not get myself in a position where when volatility comes crashing down after earnings, that hurts me. So what I'm looking to do is play some upside directional butterfly spreads, which are inexpensive ways to play a direction. They provide fantastic reward to risk. They're fairly safe in terms of, butterflies don't typically cost a lot up front. So, I'm looking at even upwards of like 130. So putting on, a 125, 130, 135 butterfly. You can even, for those that understand the option space here, you can even skew it to give yourself some extra push, some extra delta to the upside. So I would look at maybe the 125, 135, so $10 wide on the long side, and then 140. So that gives me some little extra direction to the upside.
Scott, if you could take a step back for people who don't understand what a butterfly spread is, because I know how good you are at explaining these simple terms, basically buying a call spread and selling a call spread. But
exactly right. But, lots of people get scared at option names, right? But like a butterfly, an iron condor, whatever it is. But when you break it down, Bob, like you just said, a butterfly is just the combination of a long spread and a short spread. Whether, on the call side, you can do it on the put side. So that's all it is. And essentially what you're looking for is, if you're long a butterfly, like I had just suggested in PayPal, what you want to happen is the stock to move towards that center strike. Right. That's your target, because that is the short strike, the option that you've sold in both the long and the short spread. So ideally 130 would be my target in that one.
Okay, so you sell the other call spread to cheapen it up, as well as, you're capping the risk anyway.
Totally capping the risk. I'm essentially buying the 125, 130, and I'm financing that by selling the 130, 135.
Right. So again, that's capped risk, so everybody understands, because you're long the one and short the other. That center strike is really where you want it to go.
Absolutely. And like you said, in every way I trade, it's always risk defined. I know exactly how much I can lose, regardless if PayPal goes to 0 or 1,000. I know my risk.
So I want to point out to people, because this is something we focus on a lot. It's part of the reason that we have Scott Bauer in a lot, is you have to think of trading from a risk perspective first. What is your risk capital? How much you're willing to risk to have the outcome that you've put the probabilities in your favor that you can have. So Scott's an expert at teaching that. So Scott, if people need to get a hold of you, how would they get a hold of you? How would they talk to you?
Sure. Thanks, Bob. You can just go to our website, prospertrading.com. All right. We're all over the internet. You can get free passes into our room, try us out for a day, for a week. We have instructors, myself being one of them, that teach people from the ground up how to trade options, how to trade stocks in this market. Prospertrading.com is the best way to find us.
What were you a market maker in at the SIBO? I always forget which stock you were.
Yeah, I started out trading in the Coca-Cola options pit, and then I moved over to Amazon. And for a very long period of time, I was the only market maker in the world that trade Amazon.com options. Because back in those days, dating myself in the late 90s, options were not multiply listed. So if they traded in Chicago, they didn't trade in New York or in San Francisco. They didn't trade on multiple exchanges. And I was the only one at the SIBO that traded Amazon for a long time.
All right, so Scott's not only a good guy, he's a friend, and he's a really good trader. So check him out if you have time. Scott, thanks again for taking some time out for being on our show.
Thank you, Bob.
So coming up, we're going to go to my friend Serge Berger. Serge, again, another stock options trader, which, we've got our two sponsors, E-Trade and the CME Group. You're seeing their commercials. So we're going to give you one more quick one for them because they allow us to do the show, and then we'll go to Serge Berger. We'll be right back.
This is my headquarters. This is where I trade and manage my portfolio. Since I added futures, I have access to the oil markets and gold markets. I'm plugged into equities, trade confirmed. And I have global access 24/7, meaning I can do what I need to do. Then I can focus on what I want to do. Visit your online for today to learn more.
I would just exit out of it. You're looking great right now.
We are just about back.
You have the 30, and can you hear me?
Waiting for Serge Berger to come on the stream before I can say hi to him. Serge is from the steadytrader.com. We got to know Serge in the last show, and he gave us some pretty interesting ideas of things he was looking at. So I haven't talked to Serge today yet. So I really like that, actually, because I'm going to be talking to him about general markets and then going into specific things that he's looking at. Serge has a pretty long history of being involved in the markets. He is not someone who just taught himself to trade a month ago, etc. So Serge, are you with me?
I'm here. How are you, Bobby?
Good. It's good to talk to you again, buddy.
Likewise.
So
likewise.
Before we get right into it, why don't you tell everybody about Steady Trader and give us a little bit of your background, because this is the second time you've been on the show, but we had that sort of technical debacle last time. So I'll give you another opportunity to go into it.
Yeah, sure. I originally started as an investment banker at JP Morgan, then moved on to it was mostly doing credit things like fixed income stuff and credit default swaps and those kinds of things. And then moved on to the family office and hedge fund side. And then 11 years ago, started our own company, which is an investment company and advisory and all that kind of stuff. And out of that, actually very quickly, we also started the sort of the research side of it. So where we make the research available to clients through, the lens of trade alerts and courses and chat rooms and all the kind of stuff. It's www.thesteadytrader.com. I guess that's what you're asking.
It is what I'm asking. I always want to make sure that people, we don't do commercials here. We do actual trading and stuff. We do commercials for E-Trade and CME, but that's of course because they allow us to put this show on. So from the perspective of, I don't know if you were able to hear the earlier conversations because I'm kind of new to this.
I listened to Scott. Yeah.
Right now. Yeah. So what do you think about Scott's conversation about volatility and about what he's looking at with PayPal? Do you have any opinion on that at all?
I only cut in when he was talking about PayPal, and I think it makes sense. Quite frankly, if you look at the market through the lens of a bigger picture, at the end of every month, we like to do this. I call it the monthly chart ritual with our clients, which we just sent out yesterday. And essentially, if you look at the longer term trends, there is still going to be most likely an outperformance in tech versus other stuff long term, right? And so I think within that thesis of what he's mentioning, PayPal versus MA and V, it does make sense. Also, of course, although of course those two other companies, MasterCard and Visa, they are in their own right, tech companies as well. But I will say what concerns me a lot more in the near term and potentially the intermediate term of, let's call it a few weeks to maybe more like a few months, maybe a few quarters at this point, is the relative outperformance that we've seen of NASDAQ 100 versus say the S&P, or even more severely versus the New York Stock Exchange Composite, which has about 2,000 tickers in it as opposed to just 100 in the NASDAQ. And that concentration, and I know you know what I'm talking about, and that crazy concentration. 20% market cap of the S&P is essentially 5 stocks. I do think that is going to mean reverts before we can have another sort of outperformance rally there.
So you have kind of an issue with 4 or 5 stocks leading the entire market as a structural factor.
Yes.
Okay.
Yes, I do think it's a problem, and it's not because these are bad companies. I think Apple and those kinds of things. I mean, last time I checked, I have an iPhone, I have an iWatch, I have a Mac over here. These aren't bad companies, but I think the passive investing the bubble that we're seeing is very severe. It starts with robo advisors, which have yet to be proven as a business model in downturns.
Right.
And just like, for example, I gave you a statistic, and I don't have to chart. I think I may have to chart somewhere. But basically, I came across a statistic last week of the Robinhood app. And basically, you have a lot of millennials, and millennials have been buying the NASDAQ 100 throughout this dip, like just as if it wasn't there.
Right.
And so it just shows me there's a lot of basically, not understanding of the risks, I guess, as everyone piles into the same stocks. And I do think that's a problem ultimately.
Yeah, we've talked about this on the show before. I don't know if it was on one you were on, but risk and reward they're inexorable. You can't separate the two.
Yeah.
So you can't just simply go in tech and not expect that tech would be something that would just be completely invulnerable to the risks of the major markets.
No, it won't be, and it's difficult to compare this to. I always say, there's the Mark Twain thing where the history doesn't repeat, but it rhymes, and I think we may draw some parallels between now and 2000, 2001, which I'm sure you were around, an internet bubble. But it's always a little bit different, but I'm not quite sure it's that different in terms of, if you look at just a few stocks leading market cap. I believe back in 2000, 2001, it was Microsoft. I would assume maybe Intel, Cisco, and maybe like GE or something that were leading. It was literally just a few stocks. And now it's 5 other different stocks doing the same thing.
Right.
So I think it's dangerous, to be honest with you.
Let's use Apple as an example. You mentioned that you have an iPhone, an iWatch, and I have an iPhone, an iPad, and a MacBook Pro. And then I look at my nieces, right? My nieces who are basically between the ages of 26 all the way down to 7.
Yep.
They don't know what a PC is. They would have no idea how to use one. Everything they do is Mac. So does Apple. We've seen Microsoft had earnings. They're a powerhouse, right? I mean, they just continue to outperform quarter after quarter after quarter. Does Apple become a sort of a growth, leave the growth stock world and become more, leave the momentum stock world and become more of a growth stock? And is that possibly how the rest of the market catches up, where these 2 or 3 stocks don't lead anymore?
I have mixed feelings about it. I think that is the back end of the story, or the second half of the story, where I said earlier, where I think we're going to see tech continue the outperformance. But I think if the downturn that we're witnessing now is going to be even half as bad as I think it is, we are going to see some serious mean reversion of NASDAQ 100 versus the broader market. And again, it won't necessarily be because they're bad companies, but because I think if we get another leg down, you're going to see a lot more liquidation of people that really get scared.
Right.
On that first leg down in like the second half of February, I had people call me, like friends and a lot of clients that were emailing us, oh, listen, this is a sure buy now, because they'd never seen Microsoft or Apple drop 10% in a few days.
Right.
and of course they were very wrong for a few weeks. Now they're very right. But I think it's a wrong self-assurance. It's sort of an enigma, if you will.
Yeah, I say the worst thing that could happen to a trader or an active investor early on in their career is they make a trading mistake and make money. That's about the worst thing that could ever happen, because you don't recognize the mistake. Going from a perspective of that conversation, tell me something specific that you're looking at, let's say in the medium term, because our next show is May 18th,
Yep.
right? You're not going to be with us on that show, but you'll be with us on the following show. Let's go over, say, the next quarter or so.
Sure.
And you can take that out as long as you'd like. We're not looking for something that possibly works tomorrow or the next day, but what are you looking at short, medium, and long term?
Sure. Well, for the intermediate term, which I think it was the original part of your question there, I still think we're going to have a problem, i.e. a lot of overhead supply in small caps. So you're looking at an ETF like the IWM. And I'm sure if you were to make a chart there, you can make it even like, the best thing is probably do like a monthly chart or a weekly chart and draw it back a few years on that nice charting software you got there. I think, you start to see that we've reached, there you go. And you could probably draw some simple horizontal resistance lines right around where we are to those previous lows. That should be Yeah, just kind of where we are right now and draw them to the horizontals up there.
Yeah.
And you kind of see that we've reached some pretty significant areas of overhead supply. And, so this is just a technical aspect. I believe in looking at things through the lens of multiple pillars. So I think definitely charts play a factor. Fundamentals over the long term are something worth considering, and structural imbalances is really, and that kind of comprises a multitude of things. But I look at something like this and I say, you know what, if you look at the leverage ratio of Russell 2000 stocks, like right now, the average Russell 2000 stocks has twice as much debt as they had in 2009. And I think that's going to come home to,
right?
I'm sorry?
That's pre-stimulus.
That's pre-stimulus. Yeah, forget about the stimulus. That's a whole other set of crazy. That's a good point. So basically, it's net debt versus EBITDA.
Okay.
So, and it's basically, it was at an 8 times recently, and it was about 4.5 times 2009. So we haven't learned anything from that, right? And this is a part of of the things we go through, but I think there's a lot more credit risk out there than people are pricing in right now. And if you want to look at from a trend following perspective, I think one of the best trend following opportunity out there is short Russell versus long S&P, because that trend, that underperformance trend, has been in existence for some time.
Right.
So I think specifically, I think the Russell 2000 could easily get down to 110 over the course of a number of weeks or so. I mean, this can happen today or tomorrow for all I care, but just to kind of give it more reasonable profit target. And from an options perspective, it depends. I always like to segment people between, particularly in the retail community, people are either options buyers or options sellers. And when you start mixing those things, some people get confused, which I understand. So if you wanted to do like a debit spread, I think you could do you could buy like a July, like a 125, 115 July monthly options debit spread. So you buy the 125, sell the 115, just to kind of get started. Just keep in mind, in the very short term, the Russell 2000 had some classic month-end markup, which was it starts getting a little disgusting in terms of what's happening out there. But you saw the rally in the first half of last week. I mean, the Russell rallied 10% in 3 days, and then fell 3% in the second half of the week into the end of the month, right? On the weekly chart, we've got some massive buyer exhaustion. So I think that would be good to do from a debit spread. What I like to do is credit spreads. So you take Scott's analysis before, where Butterfly is essentially doing a bull call and a bear a bull call and a bear put or something like that, right?
He's going to buy a call spread and sell a call spread.
Yeah, exactly. That's right. Exactly. So you do it correct. Now, in this case, what I would either do that directional debit spread that I mentioned, or I like to be a credit spread seller. So I go way out of the money. So right now, I'm looking at selling probably a July 140, 145 credit spread. So you sell the 140 strike and you buy the 145. Maybe you can go even more.
That's a call spread, obviously, right?
What's that?
That's a call spread, obviously, because you're going above.
It's a short call spread, exactly. Yep. It's a vertical short call spread, as opposed to the other one is a long call spread where you're buying options.
Right. And I want people to understand that is limited risk, limited reward, but the reward is smaller than the maximum risk that could happen.
Correct.
High probability trade, though.
Oh, look, what I always tell people is this: are we in this business collectively to make money?
Right.
Yes. Are we in this business to hit a home run in every trade? No. So if you want to give yourself the maximum potential to turn a profit, in my opinion, the options market, you have to be a seller of options net. Right. So this way, you think about this: if you take the credit spread, you can make money whether the ETF goes lower, sideways, or even completely against you to a degree, which is more than a 2/3 chance of making money. If you buy if you buy a put or you short the ETF, you have a 1/3 chance of making money, all else being equal. So you take out the.
I'm sorry, go ahead.
No, I was just going to say, so you essentially take out the need to be directionally right to a good degree, and you take out the need to be correct in time to a good degree. So, I mean, the rewards of this kind of strategy, to me, over the past 21 years, have just massively outperformed any potential downside of that.
But I really like the 145 strike, because that's the top end of a gap that we had down in the Russell futures, which for me, if I were going to short the Russell, it would be in the micro Russell futures, which is that tiny contract that the CME has, but there's options for people who are not futures traders. Obviously, you've got the ETFs and the way that you phrase it. So I really like the top end of that strike by that.
No, for sure. And you could probably do a 145, 140. I don't have the option chain in front of me, but whatever gets you, I'm trying to get about a $1 net credit.
Yeah.
And what's important, I'll also say, I should mention this before, I only like to hold these trades for about 2 weeks on average. And what that does is it basically, if you trade short dated options, you actually are risking a lot more than you think. Because if it goes against you, there's not really more or less your hands are tied. But by putting on options in this case that are expiring in July, but only holding the trade for 2 weeks, you dramatically limit your risk. So what happens then, you do, let's say 5 trades, instead of having the 6th trade lose all your 5 days, 5 winners, you're going to lose like maybe, what you made in like 1 or 2 trades. So over time, you'll have a naturally tending upward. And by the way, that mini contract or micro contract is a superb contract. I fully agree.
Yeah. So we're out of time. I'd love to continue this, but tell people where they can get a hold of you in case they want to do that trade.
Yeah, sure. The best thing to probably do is just go to thesteadytrader.com. So it's www.thesteadytrader.com. And I think there's you can sign up to the list, and then automatically we will be sending you that kind of stuff.
Great. Serge, thank you so much for this repeat show that you agreed to be on. And we'll get you on 2 shows from now if you're amenable to that. I would appreciate it.
That'd be awesome. Thank you, Bobby. Appreciate it. Take care.
Guys, we're going to come back with Jim Iorio and my partner, Mike Arnold. Jimmy's got an interesting broken fly that he wants to talk about. And Mike's always got interesting stuff to talk about. Stay with us. We'll be right back. If we talk over a commercial, I'm sorry, we're not good at this yet. All right, Jimmy, Mike, do I have you guys?
Yep, you have me.
I am on.
Guys, this is Mike Arnold, who's my partner in Path Trading Partners, among a couple of other businesses that we do together. And my good friend, Jimmy Iorio. I've known both of you guys double-digit years, so I don't even want to go into this. Overall, the amount of time I know you guys is longer than most people have been alive at this point, combine the two. So, Jimmy, let me just start with you if I could. Because again, Jimmy was on our last show, Mike's on every show, but Jimmy was on our last show, and Jimmy's about to become a much bigger part of what we do here at PureXposure. And the CME group, one of our sponsors, is pretty happy about that. E-Trade's pretty happy about it as well. So Jimmy, I want to talk to you about a couple of things. Number one, you have a pretty strong interest rate background, as well as just general futures and futures options background with the indices and everything else. But let me reach back to the first interview that we did on the show today with Kamal Shri Kumar. And Shri talked about the 10-year note breaking the 39 basis point low that we got in March, and that's in yield, and going all the way down to 0. Now, when we got to that 39 basis points, 10-year note futures was about 140 or so. I have the price written down somewhere. You guys see these? These are actual trading cards from the trading floor. I've got it written down here somewhere. There it is. 140.40 was the price, the high there. What do you think of that call, Jimmy? And that number one, and if you were right, you have an approximate idea where that would take the futures price?
You take the futures to about 143.25 based on the DVOs that I'm running. I like the call. There's a couple things that I find interesting. Over the last couple weeks, 0.6, well, let's call it 0.59 to 0.6 in the 10-year yield had unbelievable support level, and it's very difficult to break down below that. I don't know why, but it makes me think that it's a really, really important point to somebody. So my take on the going to 0 is I believe that's going to happen, but I want to see a 0.55 yield first, and then that's when I plan to institute trades to try to take advantage of that. I do think it's going to happen, but I need to see some confirmation. I mean, you look at yields all over the world. I mean, it's still 0.6 is an unbelievably high yield in comparison to almost everything else. And I know that just sounds so oddly, just so strange, but it is.
I can't believe I'm hearing you say that.
Yeah.
I mean, and it's true, but it's like blows my mind that you're saying 0.6 is an unbelievable yield. From a perspective of the 10-year note itself, when we're looking at the 10-year note overall, and I want to talk to Mike about this if I could, the chart itself is almost, it makes people feel like there's no room to trade that futures contract, but I don't know if that's true or not. Mike, have you looked at a 10-year note futures chart? I think June is the front month right now. And can you talk about what that chart's telling you, if it's telling you anything significant?
We're looking at it. It's in a very, very tight range. We have the rising rotation zone on the daily, and that's coming in. The bottom of it's right now coming in at about 138.21. So as long as we remain above there, it's in bullish mode, and we're watching for that again, that break above 139. Of 139.22, but it's just basing sideways in this horizontal channel. So we're essentially sitting on our hands until it breaks out. And right now it favors the breakout to the upside.
And this is kind of technical analysis, theater of the obvious, but if anybody knows, those right triangles tend to be continuation moves, and the trend has been higher. Am I right about that?
Yes, they slightly favor the continuation move.
All right, so let's move on to equities and equity futures. Jimmy, I don't know if you could hear Serge, but Serge is very bearish the Russell. Now, we've got micros at the CME in the S&P, the NASDAQ, the Russell, and the Dow. So I right away pulled up a micro Russell chart, and I saw what he was looking at on that. Do you have any opinion on the Russell specifically? And do you believe that the Russell's headed lower with the rest of the sort of the bid that we've had in the rest of the market until the last 3 days?
I do. And I think the Russell probably could lead this move on the downside. We saw some of the big tech earnings, and those, Google looked pretty good. I mean, and Amazon, the fundamental story of Amazon during our new world is relatively obvious as well. So I think that on the upside, NASDAQ probably would outperform, but on the downside, I think the Russell would underperform. I think a couple things go into that too. Let's just move to the S&P, which I look at normally, and I can kind of consider that a blend between all of them. I thought going from 2850 to 28950, we could do that just based on the notion that the government is here for us. The central bank, the Fed is here for us. The world's central banks are really here for the United States stock market as well too, because a lot of that market bleeds over. But a couple of things happened late last week. Thursday and Friday, we lost all of the week's gain. And then I don't think the Warren Buffett talk is getting quite enough attention. We're trading on sentiment. We're trading on hope. And when the guy that most people call the Oracle comes out and says he's not very hopeful, we're seeing 10% down in the airline stocks, and that's obvious. He said he was out of his. So to me, that was the little push that's going to knock us down a couple hundred points. I don't think we're into disaster mode here. I like the S&P down to around 2650, but the Russell, which I haven't looked at quite as much, I think could lead on the downside and underperform to the downside.
So I'm looking right now at the overall markets as we speak. Let's see where my indices are here. Oh, we got the S&P down almost 0.75%. That's not dramatic,
no,
right? It's not a dramatic move, but given that this would be the third day down, we also gapped lower, not by much, but we still gapped lower. Mike, are you looking at let's say the NASDAQ or the S&P 500 for any opportunities? I know Jimmy's got a trade and that I want to talk about, but I want to see if you see anything on the chart, and then we'll go to Jimmy's trade.
Specifically on the S&P, we had a divergent sell that kicked in last week. We hit the first target of 27.85, and that's pretty much where we opened last night. We traded a bit below it, but now we're back above that level. We're watching for a close now below that 27.85. If we get the close below the 27.85, we'll be below the rotation zone on a daily basis, which then puts our next major target at 26.32.
So that's a decent move.
Yeah. So but we need that key close below 27.85 to trigger that, specifically on the S&P. And on the NASDAQ, we had a triple divergent sell signal that kicked in last week.
What does that mean?
Target of 85.70. And now we're watching for a close below 85.70. It's bounced off that level last night, and we're rallying up. So we need to sit on our hands and wait for that close below below 85.70, and then our next major target would be 83.45.
When you say a triple divergence signals, that mean 3 inputs as opposed to just 1 or 2?
That means it had price made 3 pushes higher, and one of the key indicators we follow made 3 pushes lower, which is that has a success rate of 73% on a short-term sell. And
If
as
you get that close.
off on Thursday and Friday, bouncing a bit today, but we've already hit the first target, so now we have to wait for that close below the first target to then target the next level.
So let me ask you, if that, you have to get that close though, to get that probability you just mentioned.
We already got the close that we had that 73% lower, and we did hit the rotation zone on the daily basis, which was the first target. And now if we get the close below the rotation zone, then we'll have a continuation sell that then we'll be watching at 83.45 as the next target.
Okay, Jimmy, you're kind of in the same boat, right? I mean, you think that we're heading a little bit lower, at least by the trade.
Yeah, it's funny that Mike and I are in the same exact boat. We got there in a little different way. I looked at 2 weeks ago, we had an inside week. Last week, we had what looked like it was going to be a powerful upside move, lost all of it, closed almost on the weekly beat lows, and then started out today lower. To me, that's a good enough for an entry point. And I have several different types of put flies on to the downside. Some of them don't kick into different levels too, but I'm looking at one that I just played around with it so far, and I might increase my position on it too. And that's the you want the trade now, Rob? Right?
Yeah, I want to trade it. I just want to point out, Jimmy's given a trade example. He's not saying you should put this on, but
Not in the least.
I really like this trade, and I might actually put it on. So I got my card out. I'm ready to write down what you're saying here. So
And what Bobby knows this about me too. I like trades that absolutely define risk. That's why I use options oftentimes over the futures, but I use the micros a lot to hedge my options positions. But I have on a little bit of the week to May that goes off May 8th. That's just this Friday. The 2700, 2650, 2610 broken put fly. So, okay, so it's really like to think of it this way. And I do these broken put flies and broken call flies all the time. And the last show we had too, the call fly worked out pretty well. And there's a reason, I'll tell you why. So the first put spread that I'm buying is the 2700, 2650. So it's a 50 wide put spread that I'm buying. And then I'm selling the 2650, so overlapping strikes here, 2610 put spread. So it's a 50 by 40 broken put fly. And the reason is, and I paid 4 ticks for this when I started my position this morning. So that's $200 to make a potential $2,300. With these kind of flies, you usually don't make the maximum. That would mean you rode it to the last possible minute and it settled at your strike. But that's not usually what we're going for here. But what I hate about a regular put fly is spending money, having it shoot lower the direction you wanted it to, outpace the lowest strike and not make anything on it. So that's why I do 50 by 40. So if the bottom falls out of this market, I will have paid 4 but made 10, the difference between the 50 and the 40. Does that make sense, Bobby?
yeah, it does. And I love, like, the term butterfly. Obviously, you think about a butterfly and they've got these wings and then they've got this dense center body. And that's what a butterfly is. A broken fly is one wing's bigger than the other, right? One's working, one's a little bit busted, but still flying.
Right.
So yeah, that makes a ton of sense. What I really like about this particular trade is you're probably, correct me if I'm wrong, okay? You are likely to be out of this before non-farm payroll on Friday.
There's no doubt about it. When you see these binary events come up, you have to make your decision. If you have money in it, you either cover it, roll it down. It's silly to, particularly in a fly. And this has happened to me a bunch of times before I learned my lesson. A fly that's going great and you're making good money on it, and then all of a sudden you realize your risks are too high and you blow it. And I hate doing that. So with flies too, you got to keep what you're going to take out of it. Like if I doubled or tripled my money in the first couple days on this sort of fly, I'd probably take it out then, because the waiting game of a fly going to the last possible minute to make your maximum is almost, it seems like a fool's game to me, and it rarely happens. Like the last time we were on here, we talked about a 50-40 call fly, right, and I had put it on for like 10 ticks, and I took it off the day before expiration for like 25 or 26 ticks, despite the fact that it could have made up to 50 if I let it ride. But at some point in time, it gets to be too big a risk.
Right, Jimmy, you do institutional business, so there's no real benefit to people reaching out to you, but you have a pretty active and by the way, funny Twitter account. Where can people get a hold of you if they'd like to? For example, if they decide this trade is good for them, because again, this is just an example, where can they get a hold of you if they have a question about that maybe?
And Twitter, it's at Jim Uriel, JIMIUORIO. And like I said, I have an active Twitter account. And if you ask me questions, I usually answer all the questions you want. Sometimes I put out the trades that I'm doing. Sometimes I don't. It's not that consistent, but if you ask me, I usually will help.
Jimmy, thank you for being here. I want to go to Mike real quick. And again, we're going to have some announcements specifically with Jimmy down the road. So watch out for those because Jimmy's going to become a much bigger part of PureXposure. Mike, are there any stocks you're looking at specifically before we let you go, or anything you want to talk about?
Specifically, we are watching, you already touched a long time ago on the intro to the show, where we have watched our watch list of Visa and American Express for potential pullback entries. An interesting one I've been watching for a couple weeks now is Tractor Supply Company, TSCO. It's extremely overbought, but it's setting up for a potential sell pattern, in which case we'll be watching for a pullback. If especially below the $100 mark, our next key level is around 96. So we'll be watching for a pullback to there and a rotation back up, and that's a strong one on our watch list.
All right, Mike, again, is a part of every single show that we do, and he's my partner in Path Trading Partners as well. So you're going to see Mike a lot. Mike, thanks for being here. Well, where can people get a hold of you / us if they want to?
They can just go up to our website, Path Trading Partners, and reach out to us through that site. That's the best way to reach us.
All right, good. And again, I want to thank you guys for being here. I want to thank E-Trade again, the CME Group, for sponsoring us. If you want to stick around, I'm going to do a little bit of alternative investment stuff next. We'll be right back. You've just been exposed to the equity portion and the futures portion of this show. We'll be right back.
I added futures to my trading strategy. Now, I have 24/7 access to diverse global markets, including crude oil. Like I always say, leave no opportunity untapped.
All right, guys, I am back with you now talking some cryptocurrencies, and I'm pretty excited about what we've got. People don't know this and they don't really publicize it because I have no interest in discussing it or defending it, but I'm a huge fan personally of cryptocurrencies, both the mission of cryptocurrencies, so to speak, as well as, as a former floor trader, volatility is my friend. So I've never been afraid of volatility in any way, shape, or form in any sort of markets. And before cryptocurrencies became a real thing, a real tradable market, an investable asset, crude oil was the most active thing in terms of volatility that you could trade. So cryptocurrencies have now kind of taken that role. So, and I'm not upset about that in any way, shape, or form. So I want to introduce right now, we've got Robert Heffernan here. Robert, can you hear me?
I can hear you fine.
Robert is a lifelong trader, and he's got a bit of a cryptocurrency background, which again, he's a guy like me in that he was not afraid of the asset when it first came out. Where you at?
Well, it's not only I wasn't afraid. Of course, I was a little bit afraid, and I also missed the early opportunity. You know, I produce a technical trading sheet for 75 fiat assets, spreads, a lot of agricultural stuff. And I actually started toying with the math to put Bitcoin on the sheet. And to give you an example of the momentum level at that time was somewhere around $320.
Right.
And
Wow.
One of the many fiat traders that never pulled the trigger. And then I actually got involved in crypto through an ICO, providing actionable trading information in this asset class. And I'm sure Nick, who will be on here too, can affirm incredibly needed in this space for level-headed analysis that has been going on forever in the fiat world. And crypto and the backstory of its usability is one story. The disciplined trading side of it isn't going to be any different than any other thing that's ever been traded. And that's what I'm trying to come to the space with, that technical approach. And, sing me the story, but let me confirm it with the technicals. And I did it again. All right. I've lost more money listening to the story in my trading career. In the last 2 years, the African swine fever in China. Again, the story can be one thing and the market can be disjointed from the story a lot longer than you can stay solvent and able to buy lift tickets at the ski resort.
Right. It's funny you say that, because that's one of the things that got me interested in it, is that a friend of mine said to me that cryptos need an adult in the room. And I wouldn't want that to be taken the wrong way. And it's not about age, it's not about any of that. But when you see some of the analysis, and I want to bring in Nick Murphy, who is the head of the BXC exchange. And I think Nick's one of the adults, okay, to be honest. And you can see from his picture here, he's not my age. He's not yours either. So it wasn't an age thing. It's about people developing products and things that are just absolutely critical for not just the success of this asset class, because I think that's done already. It's going to be a successful asset class, but to be able to develop something like BXC and go forward with that. Nick, I'll just leave it to you. Tell us about BXC. Tell us about your role there. And again, I want to thank you for being here. I really appreciate that.
Yeah, no, I definitely appreciate you guys having me on. It's always exciting to talk with other leaders in the space. So thank you guys both for having me on, and look forward to chatting. In summary, guys, BXC is a startup. We fully launched the exchange back in last June here in Chicago. And we're a startup, so we have all the usual startup challenges of some staffing, culture, unexpected bumps in the road. Over the past year, we've encountered quite a few hardships, and frankly made some missteps. But I think we're finally in a spot right now where we've really found our stride. We recently delivered BXC 2.0, which was a complete redesign of the platform from the ground up. So we dropped BXC 2.0. That's it there. Yeah. Dropped BXC 2.0 on both the web, iOS, and Android. And have been following up with, major new feature releases every couple weeks since then. We've got a lot of cool stuff in the works.
So BXC is an exchange, right? You're the co-head of that exchange. And one of the things I come across when I'm talking to people, so you're a Chicago guy, so you know what WGN radio is. And I did a WGN radio spot, and the demographic of their listener is older than me, right? So when I was on there, the host actually said to me, he goes, "Tell me why I should be involved in this. All I hear is that your money can disappear, and they can steal from you, and it's digital, and that criminals use it and all this stuff." So we're hearing a lot about sort of the unethical, shady side, like my age group and older. But tell me more about why BXC is different and why people can be comfortable. Transparency, really, right? Why is BXC different? What's sort of the value proposition versus that reputation, which I personally think is on a company by company basis, not on an asset.
It's definitely company by company. I think that the major players, the Krakens, the world, the Coinbases, the big players, we're all trying to do things the right way. Early on 2-3 years ago, and even recently, some exchanges still now, they don't make users pass KYC, and that's just asking for trouble. What was that?
Tell people what KYC is, if you could.
Yeah. So KYC is know your customer. So when it comes to things like bad actors on the exchange and this and that, a lot of these exchanges, you don't have to prove your identification. But whereas on BXC from day one, if you come to sign up, you have to, show your ID. You have to prove that you are who you are. Do a facial scan, and that's been a big thing to help us with one, identifying bad actors, but then two, really putting a face with a profile and a trader on the platform. We've also incorporated some things that I'm very proud of, and we may get to it towards the end of this, but we recently announced a partnership with a third-party custodian that's going to be rolling out over the next few weeks. It's a company called Curve. and they are extremely cool company. They do what's called multi-party, it's multi-signature authentication. So basically, if somebody were to hack the exchange on an exchange that doesn't have a third-party custodian like this, those coins could be at risk. However, in our case with this Curve integration, you know, the coins must be signed for to be moved by multiple people on our team, a Curve representative, things like this. So it's just kind of an extra layer of security.
Hey, Hef, how do you feel about that as somebody who's like kind of, you're newish in this space. You're kind of a veteran to a lot of people being in this space, but how do you feel about those types of things where you're talking about exchange risk versus your own personal? Obviously, as a lifelong trader, you have a personal risk parameter that you would take care of. So how do you see these kinds of developments going forward in that space?
Yeah, you know, that's a great and just a different nuance in this space. And Nick, maybe you can help me out with this, because we've actually looked at this. You know, if you're gonna a buy and hold or holding your coins in a third party or some sort of safer situation is fine. And I'm not really sure, you know, with very large assets at stake, Nick, maybe you can walk us through how easy it is to trade in and out of that. For me, I don't have enough money asset wise in the space that if it got hacked, it's gonna change my life. I got in this to trade it and to give trading recommendations and trading intel on it. But we are working with, you know, large miners, people getting into the mining space. And that's a continuing question coming up as we accumulate assets, if we want to trade them, what is that process? And we're still in we're actually still in discovery on that. So Nick, maybe you could shed some light on that.
Yeah, in terms of the safety of the assets, or in terms of actually trading the assets?
Well, so the speed at which you could trade large sums of assets had you accumulated them or put them at the exchange.
So I think what you're asking is, will this third-party custodian solution slow down
Yes.
for you? It will not. No, sir.
Okay.
So it's tied in with all of our systems, and users won't even notice the difference.
Okay.
You know, it's a safety measure on our side.
Yeah.
And back to another question, Bob, that you had asked, you know, about the markets and whatnot. I personally think that, you know, there are a lot of unethical things happening in this space. There are a lot of shady operations in the space going on at lots of different cryptocurrency exchanges. I mean, if you look at the biggest website for tracking statistics, coinmarketcap.com, you know, if you look in the top 10 exchanges by volume, I've never heard of like 6 or 7 of them.
Fully agree.
You know, and you know, it just is like, okay, well, are they really doing that volume, or are they just wash trading and saying they're doing that, you know?
Right.
So that's one thing that really sets us apart, is we do not wash trade. There's not even a way to do so. We have self-match prevention, which is something that should be in the space anyway.
Right.
You know, I'm not going to name names, but I was reading through an FAQ on one of the other exchanges, and one of the things it said was, we have self-match prevention, but by default it's turned off. It's like, come on, guys.
So again, because I think a lot of the people that have stuck with us from the other show may not know what that means. Talk about self-match prevention, Nick, and what that is.
Yeah, so self-match prevention is something that you guys know have been around for years. But it basically means where if I have a buy and a sell out at the same price, those two orders can't get matched. Because if they did match, then the volume number for the exchange would then technically go up. Right. And you know, volumes could fraudulently report their data.
So what is the Beaksy vision then? Like from your perspective, is it all about the things you've just mentioned? Is that part of the vision, is making it a place where people understand that this is an exchange and I'm good here for the most part?
It's that, it's a lot of things, to be honest. You know, we want to be the one-stop shop for everything crypto related. Now that's a big thing to say, because, you know, we do have a lot of competitors that have been around and are doing really great stuff. You know, I'm friends with the Kraken guys, I'm friends with the Coinbase guys. I think they're doing a tremendous job. For Beaksy, we want to make it as easy as possible for anybody to get on and trade crypto. You know, whether that be, you know, just simply getting on and having kind of a knowledge base that teaches you. I've got some cool features coming out soon Now, there's one specifically I'm very excited about called Trender, and it's a mobile app that will, you open it up, and this will be out in, I don't know, a couple weeks, hopefully. But it'll pop up, and you as the user will be able to set your parameters. Like, I want to see signals for Bitcoin, Ethereum, Litecoin. Okay. You can then choose your signal strength. I only want to see signals above 70%. And what will happen is similar to how the fast dating apps nowadays go, where you swipe right or swipe left if you like it. This will pop up, and according to your preferences, it'll show you a chart with AI driven technical analysis, and it'll show you, hey, here's a Bitcoin chart. This right here is a signal. It'll tell you the signal, the rising wedge here with a significance of 70%. If you want to take the trade, great, swipe right. If you don't want to take the trade, you want to see the next one, swipe left. And it makes it really easy because, we live in a world nowadays where, everybody's moving quick. Everybody's on their phones. And something like finance, for example, very, very high learning curve. If the average Joe wants to get into crypto, there's a lot of reading he's going to have to do. And this kind of helps, bring down that barrier of entry because they can see a chart with technical analysis. If you want to learn more about what the rising wedge is, boom, click it. You can learn about it. So just innovative features like that to try to get people, a little bit more comfortable with the space.
So question to both of you, and I'll start with Hef. Why should somebody be in this space, Hef? I mean, why should they be interested in crypto at all? Should they trade it? Should they invest? Should they both? I'm an accumulator, by the way. And I'm at the point where I'm likely to start trading simply because I've built up a base I'm comfortable with. But Hef, why do you like trading in this space, and why should people invest/trade in it?
Let me answer that with a story, and it's different now in crypto. But my brother was walking across the trading floor, and there was a heated argument outside the Mexican peso pit, and it was so heated, my brother thought, there's got to be some money going on in this pit if these guys are ready to kill each other.
Right.
And I say that because as a trader, you were looking for that. And on the floor, noise was what drew you to it. When a pit got busy, there was a lot of noise. And you might not be trading Canadian dollars, but if you were walking in the break room and there was people piling out of the pit, you skipped your lunch and jumped into the pit to trade.
Heck yeah, you did.
Same thing for me with crypto. And honestly, when I went back and looked at that sheet that I never published in it's probably 2013 or 14 with Bitcoin at $400, and you see the move, and I really started covering it when it was the moonshot of 17. And when you watch something go from, at that point it was probably 8 or 9,000 on the way to 18 to 20,000. That gets me excited. That's why I trade agricultural products also in the fiat world, because I don't mind swinging and missing, but I do like the ability to participate in the volatility that crypto provides.
Well, I love that.
It's fun. It's fun.
If I could, real quick, before I go to that, Hef, did you know Jim Hondo in the currency?
Yeah.
Yeah, Hondo extended his career because of that peso pit.
Oh yeah, if you want a real quick story, Hondo he was covered Goldman, and he comes up to me in the peso pit and he hands me an order, and it's a stop DRT for like 470 cards, a large order.
Right.
And it was at, I don't remember the exact price, but let's say 12. Well, he hands it to me, and it's a sell stop at 12. We're trading like 13 or 14. And I have another 1,000 cars stops at 09. Right. And so he hands me, he's like, and so I get the order. I look here, I go to Morgan, and hey, give me a price on a couple hundred. And the guy gives me 11 bid on 200. I go, sold. Give me another 10 bid on 200, sold. Hondo looks at me. He's like, what are you doing, man? It's DRT. Somebody says 10 at 9. I go, 1,000 at 05, 1,000 at even. He's just sitting there. He comes back to me later, and he says, my customer said that's the best DRT he's ever had.
Yeah.
But anyway, yeah, Hondo, he jumped in on it too. Yeah, great guy.
He's a great guy. I miss that guy, actually. Nick, if I could, same question. Why should people invest in crypto, like what's in it for them, right? Why should somebody go from, Hef mentions he trades agriculturals. Clearly he's open-minded and he's like, okay, here's another thing. And it might be just because of, well, in part because of his experience with the peso. So what's in it for people? Why should they put that effort in, Nick?
So there's a couple things I'd written down that I'd like to talk about, but I kind of want to go off script a little bit here and say that, look, over the past, look at the COVID stuff, man. The government has printed trillions and trillions of dollars, right? Bitcoin has a limited supply. And so, at the very least, I think it's smart for everybody, whether it's, a retail investor or somebody else. Why not hedge at least a little bit into a digital asset like Bitcoin? Because you never know, a lot of people will tell you they're in it for the tech. I think there's a lot of cool tech that's coming, but I think it'd be smart to just put a few percent of your portfolio into just something like Bitcoin. I mean, some of the largest, asset managers in the world are already now advising a few percentage points of exposure to crypto markets. Right. And they do so because the potential for gains is there. And crypto has seemingly been pretty uncorrelated to other global markets and asset classes. I mean, especially during this COVID time is a great example. I mean, you watch the oil futures or crude go down, ridiculously low, record lows. Bitcoin just kept chugging along, So why do I think people should get into it? Is why not? 20 years ago, people didn't carry a debit card around; they carried cash.
It's funny you say that, because that was a question on that WGN radio interview I did. The host actually said to me, why should I get involved in something that I can't see and that criminals use? And my answer to him was, pull cash out of do you have any cash in your pocket? He goes, yes.
No.
Pull it out and look at it. And
he did have some.
That's what criminals use right now, but you have that in your pocket. So It makes no sense. And I believe that not only does the macro success of cryptos rely on one or two of these becoming a usable currency, but we're almost there now. Like we have a particular deal with we do some analysis for institutions. We have a particular deal with a crypto institutions where they're paying us in Bitcoin. It's a currency for us. That's how we're getting paid. Yeah. So one of those things that, not only to add to your why not, but I think one of the mistakes people make during this, and I'm sure you guys have all experienced this being market related, during this COVID-19 pandemic, I can't tell you the amount of people who said, I've got $5,000. What one thing should I put it in on? What one day should I do it?
Yep.
And I think that's the opposite of what Nick is saying. Nick's saying, put a little bit in. If it goes down, put
just to start, man. I mean, if you're sitting and you've got 5K just sitting there doing nothing, sure, go all in on Bitcoin. But if you're not, and you're, especially right now with COVID, with people's jobs all over the wazoo, and just I have friends ask me all the time, what should I buy, this or that, and I'm like, dude, just take $100, $200, $500 a week and just buy Bitcoin and forget about it.
Are you guys both Bitcoin? I did a TV interview 2 years ago where I said I didn't know if Bitcoin was Facebook or MySpace, and that was
good example.
And now I believe that Bitcoin is Facebook. Are you guys going to say? I'll go to Nick first since you're on the screen.
I think it could. Here's what I think. Do I think Bitcoin is going to be the end all that takes over the dollar? That's a stretch. But what I do believe is that some digital currency with a limited fixed supply like Bitcoin will ultimately take over the dollar. Whether it's Bitcoin, I don't know. It could be.
What do you think, Hef?
For me, I don't know. I do know this, and the thing that intrigued me first getting into crypto and blockchain was the very premise of it, that people act in their own interest. And when you put together a system that is fairer for everybody because it's decentralized, at the end of the day, it's got to be a better system than what we've had throughout humanity. And that really caught my eye. And so, and I truly believe that fundamentally is going to play out over time, whether it's Bitcoin or not, I don't know. And I'll go to the chart to let me know that. I said to Nick yesterday when we were chatting about this, like, don't tell me Bitcoin is going to $20,000 or $50,000 or $80,000 as a technician when it's closing in weekly, momentum to the downside. So I'll let the chart tell me. I'll also let those cross charts tell me against Bitcoin if there's a better play to be in the space. And I'm going to trade it just like I traded, as I said last time I was on the show, Bob, the guys in Chicago that traded soybeans forever and never had seen a soybean and couldn't pick one out on the table.
Right.
But I do, so I'm coming at it from two sides. I believe fundamentally over time, this technology is going to change humanity.
Well, I think most people that buy a stock, I actually brought that up to another friend, and somebody said,
Right.
"Do you know anything about this?" I said, "Well, do you own Apple?" "I do." "Well, what do you know about their financials?" "Well, I don't know. I don't look at them." Exactly.
Exactly. That's exactly the right answer. Exactly.
Value. And as the perceived value of cryptos grow, and that's why personally I'm an accumulator. Although again, I'm going to start trading it very shortly. And actually I'll talk to you guys off the air about that at some point, but
Right on.
I'm going to start trading it very actively shortly. So just kind of as a wrap up, Nick, I want to give you the opportunity to say anything I've missed about Beaksy itself, because again, you're an exchange, people should know about you and where they can get a hold of you. And is there any plans that we haven't talked about, any pivots or anything you've done in your business that we that I want to get?
Yeah, I mean, we're definitely busy. I'll tell you that.
About the halving, but I think I'm going to save that because the Bitcoin halving is happening May 18th, and somewhere around there, and we've got another show. So I think it's more important to talk about the halving right around when it's happening or just after.
Perfect.
As opposed to. So I'm going to go to that with you, and then Hef, I'm going to ask you if you have any final words about the space at all. But Nick, go ahead.
Yeah, man, I appreciate it. So, I kind of mentioned the Swipe app that we've got coming out that we're really excited about. The other things, we're just, let me say, our guys stay busy. This is, we work every day and we're working hard to deliver a product that is right for the people. So over the next couple months, we'll have fiat onboarding and offboarding in 160 different currencies globally, which is huge. That'll be a big differentiator for us. We recently released the APIs so people can plug in and trade algorithmically. We've got good liquidity, and then we've got some programs that I'll just, I'm not going to get into them now, but I'll shoot some links and maybe you can post them with the stuff. But we've got this program called the STK program, which actually pays out a reward to users who then lock up crypto on the platform. So if you're a holder, like you mentioned, accumulator, you could use Beaksy and stake the tokens and actually earn a reward for doing so. So all in all, I mean, we're just striving to be the first exchange that can market itself as the real one-stop shop for traders.
Hef, how's that all sound to you, buddy?
I'm telling you, I've followed these guys since they started. The thing that impressed me about them right out of the bat is that they come from the fiat world. They're realists. They understand that transparency, my word is my bond, that is, so second nature from guys in Chicago, the Chicago trading environment. And it's a crazy world. I've left Chicago and I found out that that's not true with everybody, that
No.
everybody's word isn't their bond. And I just was very impressed where they came out of, what they were trying to accomplish. And Nick, congratulations on the work so far. And I really
very much appreciate it, man.
Look forward
lots
to
to go, but really appreciate the kind words, man.
So look, I'll tell you guys both before we wrap up, I'm really happy that you both took time. Nick, I know you're a damn busy guy, and Hef, you're always very gracious with your time with us. So I really appreciate that. I will say that when the CME group came out with the futures is when my ears perked up. And just going from a perspective of like, okay, this is the CME group has said this is a product that people are going to need to hedge. And if you don't think during this COVID-19 lockdown where you could barely go to your bank, that you should have at least a portion of your funds somewhere where you control them, where no one else can get them,
Nope.
you're being naive at best.
Yeah.
So looking from a perspective of what governments are able to do, not just with your money, but with money in general. So
Exactly.
Nick, you said where they can reach you. Hef, you got a Twitter or social media or anywhere?
HFR from the floor.
HFR from the floor.
On Twitter.
Give a shout at the
Yep.
website again, Nick, so people can find you.
Yeah, I was gonna say, and the website for BXY is just beaxy.com. And you can find me on Twitter at Nick Murphy with 2 underscores. Somebody took the good name.
Guys, thank you so much. You guys, thanks for watching. You've just been exposed to the crypto side of our show. You were exposed to the traditional market side of our show. May 18th is our next live show. We hope to be back in the studio. We can do live trades once we're back in the studio. I've been kind of itching to trade in front of you guys and just haven't been able to do it with this kind of environment. So guys, thanks again for being here. Audience, thanks for watching. You've been exposed to crypto.
Thank you, Bob.
Thanks, guys.